So the Consumer Price Index, or the CPI, in Singapore for September 2022 was a high of 7.5%, which is almost as high as the 2008 financial crisis. And we might not feel it right now, but there are many signs that are showing us that an impending recession might hit us, which is something that we got to be prepared for, because this recession might be one that will take us a long time to recover from because of all the other things that are happening around the world right now.
Now the shit has really hit the fan.
But today, let's talk about some channels of investment or some investment instruments that we can use to spread our money out and try to make it through this recession together, hopefully mostly unscathed. So as we know, there are many different instruments out there that are available in the market right now. We have bonds, we have ETFs, we have stocks, we have futures, we have options, and we have mutual funds. Although not all of these are available for retail investors like us, but there are three main instruments that we can easily get our hands on to get started on investing, even if you're a beginner, which is stocks, bonds, and ETFs. So these three instruments are probably the easiest to get started with because of the different providers that are available in the current market. So stocks, bonds, and ETFs are easy to understand, but if this is the first time you're hearing all these terms, let me break it down for you. So stocks are also known as equities, and these are all interchangeable within the use of the terms, but they are mainly the same thing. So in the stock, you are mainly owning a small percentage of a company, so when you purchase a stock, you are essentially purchasing a small part of the business. So some stocks like Apple or Disney do give a small dividend of roughly 1%, but there are other companies that do pay more dividends of 4 or 10% onwards. But these comes with some risk because there are things like payout ratio, all the other stuff that you have to understand. Personally love these stocks because it gives me some income on a regular basis, which can then be reinvested, and in some way it compounds your money. So there's another group of stocks that do not pay dividends, and more likely than not, these are the stocks that are in the tech or in the growth sector. So these can include Tesla, Shopify, and Amazon. So if there's no dividend, the way you earn from these stocks is through price growth. Just like buying Amazon at $100 and then selling it off at $200, which nets you $100 per share. So if you do understand what stocks are, then this makes understanding ETFs a little easier. So an ETF is a basket of stocks. And this means that a fund manager takes a few different stocks and put them together into an ETF and then sells them to investors. So for example, VOO, which is the S&P 500 ETF, contains of the top 500 companies in the US all in one ETF. So this means that you can purchase VOO and essentially you're holding the top 500 companies in the US, and you only pay a small price of roughly $300 per share. And lastly, we got bonds. So bonds are basically lending out money to either a company, a country, or a government. And in return, you receive a small interest for lending your money to them. So if you're lending to a corporate company, then it's called a corporate bond. And if you're lending to a government, then it's called a government bond. So many people will say buy stocks and hold them, and in 10 years you get some good money, which I don't deny, and it has proven to work. If you have invested $1,000 in 2010 into Netflix, the one where we spent a lot of time searching for videos to watch rather than watching, you would have net a $13,674 in portfolio right now. So this might sound very attractive and nice, but do remember that it's a 10-year wait to get that almost 13x. And this means that your money is more or less locked up for a 10-year period, which is something most of us might be okay with and some of us might not be comfortable doing. So one of the downsides of a stock market is that companies can go bust as well. So for example, a company like Mosaic, if you bought them in 2010, it was $59 a share, and over a period of 10 years in 2020, it was only trading at $18 a share.
So, sorry you lost so much money last night.
So another example is like a company in Singapore called M1. So M1 is one of the telcos in Singapore, and they got delisted off the Singapore exchange. So there are some risks associated with stocks, and that is something that you have to understand, that companies might close down and the stock price might just crumble. So now let's look at ETFs. Since these are a basket or a group of stocks, they hold fairly less risk because of the compositions of stocks that will more or less balance out the profits and the losses that each stock has. So ETFs, like stocks, can be traded on the market, and depending on the ETF you have, it can provide some diversification across different industries, sectors, and sometimes even markets. So for example, QQQ is a tech ETF which is super heavy in tech firms like Apple, Google, Amazon, and QQQ can see high growth, but at the same time when the tech crash comes in, this ETF will get hit pretty hard. So something to consider is getting an ETF that kind of gives you a bit more spread across the different industries, but that's really up to you. So let's talk about the cons of an ETF. So one of the cons is the management fees, because ETFs are somewhat managed by fund managers, but they are more passive as compared to mutual funds, where mutual funds managers regularly switch funds, and these mutual funds usually have a management fee of roughly 1 to 2%, which probably eats up a lot of your potential profits. As compared to stocks, ETFs do have a management fee that can range from 0.02% all the way to 0.5%. But ideally, you want to have an ETF with the lower fees, which gives you higher margins for profits. But that shouldn't be the only way that you choose an ETF. So lastly, we have bonds, which are considered fixed income instruments because it pays a fixed percentage over a period of time. So Singapore Savings Bond, which is currently being offered at an average of 3.21%, is considered a pretty good bond to have because most of the bond pay somewhere between 0.5 to 2%. And naturally, with less risk, this means that the potential for profit is much lesser as well. So compared to stocks that can give you a 10% growth in a year, an ETF can pay 4 to 7% of dividends, a bond is only paying out 1 to 3% at max, which is considered very, very low. But definitely there will be people who likes bonds a lot because of how low the risks are and how easy it is to get bonds. So we have talked about the 3 different instruments today, which is bonds, stocks and ETFs. So let's talk about allocation of these assets right now if you are planning to enter the stock market or to start an investment portfolio. So Warren Buffett has a 90-10 formula, which is taking 100 minus your age, and that will give you a percentage that you should have in stocks or ETF, and the rest should be in bonds. So for example, if it were me, I should have something like 32% in bonds and 68% in stocks and ETFs. But then there are many other people out there who are giving different modifications like 110 instead of 100, and Jim Cramer has another formula which is based on age. So according to Cramer, he says that at age 20 you should own roughly 0 bonds, but if you're in your 30s it should be 10 to 20%, if you're in your 40s it should be 20 to 30%, if you're in your 50s it should be 30 to 40%, if you're in your 60s it should be 40 to 50%, and above that age it could be 60 to 70%, or depends on what you have for your retirement fund. But ultimately there is no right or wrong in which formula you use, and I myself have roughly 20% in bonds. But I'm still purchasing more because of the current market situation, and I want my money to be earning something instead of just sitting in my bank account. So to start building your own portfolio, you can check out some of the brokers that I'm using like TigerBrokers and SyfeTrade to get your stocks or ETF. And for bonds, you can consider getting the Singapore Savings Bond, which is backed by the Singapore government. So if you guys are still watching, thank you so much for sticking through. I hope this video has brought you some value. Drop a like if you haven't, subscribe, turn on the notification, and as always, stay safe, invest safe, and I'll see you in the next one.